Hi there, Tanya here at Westchase Financial Planning, and today we're going to be talking about active versus passive investing. What investing philosophy do you have? So take a second to think about it. What is your investing approach? Is it actively managed investments or is it passive investments? Before we get too far, let's think about the role of a financial planner. A planner's role is to help you, the client, become more comfortable with how money impacts your life. The planner's role is also to help you make decisions with your money that allow you to do what you want. The planner's philosophy may be different based upon their own education, experience, and employment history. They may have varying opinions regarding the role of investments. Some may heavily stress the role of investments in your financial life, while others may stress other items such as insurance, estate planning, financial management, or other aspects that affect the complex relationship between you and your money. This here is the distinction between active and passive investing. Philosophical differences between active and passive investing reflect the differences in the previously mentioned investing approaches. An investor with an active approach will believe that a technically sound investor or investment manager can select individual securities, such as stocks, bonds, commodities, or other investments, that will outperform the market as a whole. A passive investment philosophy believes it is better to use index-based securities, such as an S&P 500 Index Mutual Fund or ETF. An ETF, or exchange-traded fund, is similar to a mutual fund except it trades like stocks. Most active investors underperform against the index they're competing against. For example, in the 2014 SPIVA, which is basically the Standard & Poor's scorecard that shows how well actively managed funds perform against various indices, showed that 86.44% of active large-cap mutual fund managers failed to match the S&P 500's performance over a one-year period. This trend holds true for mid-cap funds and small-cap funds. 66.23% of mid-cap fund managers underperformed in the S&P Mid-Cap 400, while 72.92% underperformed in the S&P Small-Cap 600. In fact, in the 2014 SPIVA, there was not a single asset class in which asset managers outperformed the index they were tracking. However, to look at any of the advertising material, it seems that all the actively managed funds beat their index, or the average return. Many financial planners feel that the time and effort that go into researching stocks could be better spent finding other ways to deliver value to their clients. For example, instead of 4 quarterly investment reviews per year, a tax-focused advisor might substitute one of those meetings for a tax planning meeting. During that meeting, the advisor and the clients might find a tax planning opportunity that saves $1,000 in annual taxes. Over the course of a year, it would take a 1% outperformance on a $100,000 portfolio to accomplish something that many people discover over the course of a 2-hour tax planning session. You could uncover similar opportunities in cash flow management, an insurance review, estate planning, or just identifying ways to move into less expensive investments. Many passive approach believers insist that advising on low-cost, index-based investments allow them to keep client costs down and deliver more value. An advisor who can save their client 1% in fees and demonstrate that value to their client is one who will probably keep that client for a long time. Cost is directly tied into an advisor's value proposition. There is not a very clear correlation between price and value when it comes to financial advice. You can find very competent, capable, and personable financial planners who charge reasonable rates, and you can also find the opposite, planners who do nothing for you and charge exorbitant fees. According to a 2015 Morningstar study, the asset-based average expense ratio for a passive fund is 0.20% versus the average active ratio of just under 0.80%. The great news is that over the past 20 years, financial education has led to consumers moving more and more out of active funds and into passive investments. This outflow of money from the active funds has driven down their cost, but they're still much more expensive than a passive portfolio. To put it into perspective, this 0.60% difference on a $500,000 portfolio represents $3,000 per year. A good financial advisor who is able to demonstrate this kind of savings and make sure your money is still wisely invested will probably be able to uncover a lot of other financial planning opportunities and demonstrate their value. Hopefully, this video helps to shed some light on the differences between active and passive investments. While we tried to keep this unbiased, you might have figured out that Westchase Financial Planning is a fan of the passive investing approach. It became more and more difficult as we started putting together the information. Certainly, there are some mutual fund managers and advisors out there who can justify their extra costs. When you look at the facts, it's pretty clear that there's a better place for you to put your time and money than trying to outperform the stock market. And honestly, you should have that same expectation of your financial advisor. They should be spending their time in the areas that make the most sense for their clients. So what do you think? Westchase Financial Planning is on Facebook, Twitter, and LinkedIn. You can also find us at westchasefinancialplanning.com, or you can email us at Tanya, Tania, at westchasefinancialplanning.com, or Forrest with 2 R's at westchasefinancialplanning.com. You can always give us a call at 813-920-1445. Thanks for listening, and have a great day.